Welcome back everyone, and in today's video, we're going over 6 of the best stocks to take a look at this week. And we have a ton of variety. We have some high-flying growth companies, some beautiful blue chip dividend payers, and we have a very young SPAC that has the potential to 5 or 10x over the next few years. And now that we're back into earnings seasons, we have a ton of major companies on the market, all sharing their latest results over the next few days. And when earning reports come out, they may lead to some share price volatility, leading to huge buying opportunities for some of the largest companies in the world. All these companies are diversified across various different sectors of the market. They're all leaders in their respective industry. And as a whole, any of these companies we're going to go over today can be a nice addition to your portfolio over this next week. We do this series every single Sunday. And if you're new to the channel, I am the Gen Z investor. And every single day we talk about the stock market, going over different stocks you can buy and sell, and discussing any stock market major news or headlines. So please hit that like button, subscribe for daily videos about the market, and we're going to jump right in to stock number 1 in today's video, which is Netflix. The company currently trades below $500 per share, and the share price has grown by more than 46% over the past 1 year. They currently have a market cap of $220 billion, and we all know Netflix for being the leader in the video streaming services. And as a whole, that sector has absolutely exploded throughout 2020 and early on this year because of the new stay-at-home economy caused by the pandemic. And if we take a look at Netflix stock, on the 1-year chart, they've actually been trading sideways for the past 6 months. Since the middle of July 2020, not a lot of share price movement, and the company has only gained around a 1% increase. But we're talking about Netflix in today's video because they share their latest earnings on January 19th, 2021. And we have a revenue estimate for Netflix at $6.6 billion and EPS of $1.41. And the general consensus from analysts is that Netflix will do very well because over the past 90 days, we have seen 27 upward revisions of EPS estimates. So over the past 3 months, analysts are only bumping up what they're expecting from Netflix over this latest report. And you can see over the past 3 quarters, Netflix has actually missed earnings per share expectations. And every single time they report and they miss those expectations for earnings, we have seen the share price decline by a significant amount on the day of the report. So keep your eye on Netflix. If you believe they can continue to grow long term and that the short term increase in expenses hurting their bottom line is only temporary, then this may be a nice week to buy into this company if they do miss on revenue or EPS and the share price do take a huge decline. And you can see in future quarters in 2021, analysts have some huge expectations for earnings and expect them to bounce back in a major way. We're expecting 36% year-over-year growth, followed by 60%, followed by 51% over the next few quarters in the future. And Netflix has had some beautiful growth history if we just take a quick look at their income statement. Back in 2015, they had around $6.8 billion of top-line revenue, and now that sits close to $24 billion over the trailing 12 months. And you can see some beautiful exponential growth in the top line over the past 5 years. And their bottom line and their net income has continued to grow each and every year as well. You can see they just barely made any profit back in 2015 to now over $2.8 billion of net income in the trailing 12 months. So if you believe in Netflix long term and you want to get into at a lower price, if they do miss on EPS expectations this week, like they have in the 3 previous quarters, then it may be a nice time to jump into this high-flying growth stock. So now if we move away from Netflix into the second company in today's video, we have Goldman Sachs. This is one of the leaders in the investment bank financial services market, ticker GS, currently trades around $301 per share. They're up 22% on the 1-year chart and have a current dividend yield at 1.66%. And Goldman Sachs actually trades at a very fair valuation even at this level, with a forward PE of only 12.47. And in the financial sector, all of the main players report earnings within the same 2-week period. So last week we saw reports from JP Morgan Chase, Wells Fargo, and Citigroup, and now in this week of trading, we have the rest of the leaders in the financial sector all sharing their latest quarterly results. So if we take a look at Goldman Sachs, they're expected to report on January 19th before market open, and the revenue estimate for GS is at over $10 billion. And analysts have been bullish on this company as well, upgrading their EPS expectation 15 times over the past 90 days. So if we take a look at their previous 4 quarters of history, they've missed on expectations twice, followed by 2 massive beats in EPS numbers, beating by $2.35, and over the latest quarter, they beat on earnings per share numbers by $4.18 per share. And you can see over this latest report, we're expecting over 56% year-over-year growth, followed by 116% in the quarter after that. And GS has been one of the best dividend-paying stocks in the financial sector. They currently yield 1.66%, which of course is on the lower side, but they maintain a very small net income payout ratio of only 20%, meaning the dividend is extremely sustainable, and they have been growing that dividend at a massive rate, averaging over 14% annual growth over the past 5 years. So this company right now, I'm actually very bullish on. I do like the financial sector, and I think Goldman Sachs, trading at this valuation with a forward PE of only 12.4, is at a nice level. And if we see a pullback because of their latest earnings, this is definitely a dividend-paying company I will be keeping my eye on over the next few days. And now moving on to the third stock in today's video, we have Proctor Gamble. Ticker PG, who currently trades around $135 per share, has seen slow increase over the past year of only 7%. Their current market cap is $334 billion, and their current dividend yield for this dividend king is 2.35%. So Procter & Gamble is one of the best dividend companies on the market because they sell necessities. They own hundreds of different brands. They are within every grocery store, convenience store, supermarket all across North America, and their products are being used every single day. All of their products combined have served around 10 different segments of the consumer market, such as baby care, feminine care, oral care, skin care, and many more. And what they do is sell pure necessities. To live your daily lives, to be healthy, to just get by over your entire lifespan, you will use products owned by Procter & Gamble, and that is why I love this leader in the consumer sector. But over the past few months, they have been trading similar to Netflix. Not a lot of movement. Since the month of August 2020, shares are almost flat since that point. And I actually own Procter & Gamble in my personal portfolio, and if we take a look at PG, it is one of the highest weights in my consumer sector, and I own around $3,000 of this dividend king stock. They report their earnings this week as well. They report on January 20th, and we have a revenue estimate of over $19.2 billion. And I'm actually expecting big things from Procter & Gamble because late in 2020, they actually raised their full year guidance for 2021 by a few percentage points. So that means that they were actually expecting to do better than previously noted. And that's shocking because a lot of companies, caused by the pandemic, are either not giving future guidance or reducing their future expectations because of the lack of consumer spending. But PG is the complete opposite, actually raising their guidance. And you can see over the previous 4 quarters, they have beaten EPS expectations each and every time. And for many quarters in the future, we're expecting slight single-digit growth down the road. So PG is a massive blue chip dividend payer. We don't expect any crazy double-digit growth from this company. But what we do expect is long-term consistency. They will continue to grow over the next few decades, and I have no interest in selling out of my Procter & Gamble shares anytime soon. And what's extremely impressive about this business is that their current yield at 2.3% is average, but they have been growing their dividend for 64 consecutive years. So through every recession and depression we've seen over the past 64 years, they've continued to grow that dividend payment each and every time. And they're still maintaining a sustainable dividend payout ratio of only 56% of their net income. So definitely take a look at Procter & Gamble this week. If we see any type of pullback over their shares, I will be adding to this position. I'm not really up too much from my original cost basis. So for me personally, I may even be able to average down over this week if we see a dip. So PG, a main player in the consumer sector, not much more I can say, long-term sustainable hold in my personal portfolio, and I'm definitely keeping an eye on them this week and their latest earnings. So now we're going to jump right back into the financial sector and take a look at Bank of America. Ticker BAC currently trades around $33 per share and is down close to 5% on the 1-year chart. And if we take a look at their historical performance, you can see back in the month of March 2020, when the entire stock market crashed, the financial sector got hit very hard, and BAC dropped by more than 40%. And their 52-week low actually hit below $18 per share. So the company has seen a recovery from that low point over the past 8 to 10 months and is currently trading 5% down from their pre-pandemic level. They have a market cap at $285 billion with a current dividend yield at 2.18%. I own Bank of America. The two main players in the financial sector that I own are JPM and BAC, and I plan to hold these companies over the long term. And one of the best investors of all time, Warren Buffett, actually bought a ton of Bank of America stock during the decline in the height of the pandemic. So when a lot of people were terrified of the financial sector, Buffett was buying, and he currently owns around 12% of Bank of America. And if we take a look, he bought in the midpoint of July to end of August 2020. So from the start of August, where the share price was around $24 per share, Buffett's newest position is up more than 32% from that low point, and I think Bank of America is only going to continue to climb even higher. So last week, we got reports from JPM, Wells Fargo, and Citigroup, and we actually got mixed numbers. JPM beat on top and bottom line, and Wells Fargo and Citigroup had mixed results. But I consider JPM and BAC the top tier of banks, and I think Bank of America will follow in JPM's footsteps and beat on both top line and bottom line expectations. And if we take a look, their revenue estimate is at over $20 billion, and their earnings per share expectations have been upward revised 14 times. And if we take a look at their dividend scorecard, their current dividend yield at 2.18% is average, but it is sustainable, making up only 40% of their net income, and they've been growing it close to 30% averaged over the past 5 years. And of course, banks are actually not allowed to raise their dividend right now. The Fed has that restriction in place, but they are allowed to do share buybacks starting this year. So companies like JPM, Bank of America, for example, are going to be doing a ton of share buybacks to increase shareholder value. So I'm definitely going to keep an eye on Bank of America this week, and I'm sure Warren Buffett will be doing the same. He owns around 12% of this major bank, and I think they will continue to go even higher than where they are today. So now if we move away from financials, finally we're going to jump right in to stock number 5 in today's video, and it is United Health Group. Ticker UNH, currently trades around $350 per share. The company has climbed up more than 18% on the 1-year chart and is one of the largest companies in the S&P 500 with a $333 billion market cap. They have a dividend yield at 1.42% and trade with a forward PE just below 21. They report their earnings this week as well, before market open on January 20th, and we're expecting a revenue estimate of $65 billion. This company brings in a ton of revenue. In a 3-month span, we're expecting $65 billion for their top line. And we do have mixed results, 5 upward revisions followed by 9 downward revisions in EPS, and their earnings per share expectation is $2.38. And over the previous quarter, they've beaten expectations each and every time, but we are expecting a major pullback in earnings over the fourth quarter of 2020. And again, this is one of the best dividend paying companies on the market right now. Yield is very low to start out at only 1.4%, but they have a very, very low net income payout ratio below 30%, and their dividend growth has been absolutely incredible. So although your starting yield is on the low side at that 1.42%, it grows, averaging over 20% annual dividend growth over the past 5 years, which is absolutely incredible. And that dividend growth rate makes that lower starting yield very valuable because your amount that you collect in dividends will compound over the long term at an extremely fast rate. So definitely take a look at UNH this week if you want to add to your healthcare sector in your portfolio. And now we have finally gotten to the 6th and final company in today's video, which is ticker SRAC, or Stable Road Acquisition Corp. They currently trade for around $20 per share and have more than doubled over the past few months. So this is a blank check SPAC company who is now merging with Momentus, a pure play space deal, and is valued at $1.2 billion. And after the merger takes place, it will trade under ticker MNTS. So why we're discussing Momentus today is because of ARK's new ETF, which is called ARKX, or a space exploration ETF. ARK announced that last week, and since that announcement, all space-related companies have absolutely exploded, and I actually believe this company and many more in the space industry are going to climb even higher. And I made a video going over the top 3 space companies for that sector and the future growth because of the new ARK ETF to take a look at and check that out on my channel if you want to learn more. So ARK Invest has been one of the best fund managers over the past 5 years, and people I believe are going to be flooding in to this new space exploration ETF, and companies like Momentus, which is a pure play space company, it's the space infrastructure brand, are going to see some huge rewards over this week and for many years in the future. And this is actually one of the SPACs that I really plan to own in my personal portfolio over the next few weeks if we see any type of dip in share price. And what this company really does, the founder gave a great example in an interview with Forbes. So they don't build fancy rocket ships. That's not the business that they're in. What they essentially want to do is help other companies operate within space, and I'm going to read with you how the founder describes the business model in simple terms. He says, "We help companies operate satellites in space. Once satellites are delivered to space by rockets, our vehicles will transport the satellites to custom orbits. We also plan to reposition, refuel, repair, or deorbit satellites at the end of their useful life. Our customers will host their payload in our vehicles, and we will provide power and orientations to keep the orbit without the need to build a satellite." So they're not building satellites, they're not building rocket ships. What they're doing is they have a vehicle that will position those satellites in outer space for other companies. So they're going to be a service provider to some of the larger name brands in the space world, and I absolutely love that business model. And in their investor presentation, they laid out exactly how this is going to work. So a rocket leaves Earth carrying the Momentus service platform and the transport vehicle along with the customer satellites. So this rocket, built by other companies, transfers their vehicle up into outer space, and once it's in the outer space world, Momentus's transfer vehicle carries the customer satellites, moves them into the correct orbit, and then that vehicle itself, owned by Momentus, can either reorbit, refuel other vehicles, stay in outer space for future missions, and that's essentially what they do. I talked about this a little bit more in depth in my best space stocks to buy now video, so definitely check that out if you want to learn more specifically about Momentus. But this is the player to do your own research into if you want to get into space exploration and if you want to get into a pure play space company. A lot of other main players on the market right now dabble in space, but they do everything else to actually generate revenue. This is a company solely focused on outer space, and I actually love the business model that they're proposing. So this is definitely a SPAC I'm going to add to my little portfolio of my high-risk stocks very soon. I will update you when I do buy in and at what price I buy in and for how many shares, but definitely a company I'm personally very interested in because of ARK's new ETF, and I believe that entire sector is only going to see an inflow of billions of dollars, sending shares much higher than where they are today. So those were 6 different companies to take a look at this week. As you know, I'm the Gen Z investor. We talk about the stock market every single day, and every single Sunday, we go over the best companies to take a look at over the next few trading days. We saw a ton of earnings reports this week, and we took a look at the higher risk SPAC that may see some exponential growth because of ARK's new ETF. So thank you for watching, everyone. Please hit the like button, subscribe for daily videos, and see you in tomorrow's episode.